This podcast is brought to you by Unit 21. If you've been thinking about how AI is affecting FinCrime, you're not alone. In fact, this is a top concern for most risk and compliance teams. That's why Unit 21 is hitting the road this summer for Risky Business, a FinCrime ops tour, bringing together select groups of fraud and AML leaders to share what's actually working and what's not in the age of AI. No fluff, no vendor pitches, just real conversations and tactical insights with peers who are deep in the fight. And the best part, you can catch me, yours truly, at the New York stop on August 13th. To learn more and RSVP, go to unit21.ai/riskybusiness. See you there. Hi, and welcome to episode 14 of FinCrime Unfiltered. I'm Sarah Beth Felix. Thanks for joining us again. Cannot believe it's been about 2.5 months of these weekly episodes. I want to thank everyone for their continued viewing, and please don't forget to like and subscribe if you like it. If you don't, then send me a message. I'd love to hear from you. FinCrime Unfiltered at illicitedge.com, or you can find me on LinkedIn at I Follow Dirty Money. Would love to hear from anyone. I know last week I offered the NAICS code, industry list code. I'm going to be talking a little bit about that again today. Had a really good response. Lots of people asking for the NAICS code with the FinCEN overlay of higher risk industries. So please keep those emails coming. I've sent out a lot to practitioners. So please always reach out. All right, so today's show is probably going to be a little bit shorter than the other ones because I originally tried to keep it short. And then the other ones just had so much stuff going on that I felt like they went over time a little bit. So today I'm really aiming for a shorter episode just because time is money in your world and in mine. So I wanted to follow up on my comments from the Genius Act. I know that I wasn't probably as encouraging and as some of my colleagues are about some of the acts, not just the Genius Act, that have been passed. But I wanted to offer what I think is a great way forward. And in perfect timing, Hong Kong Monetary Authority, earlier this week, they published their rulemaking on stablecoin issuers. And I've said before in other episodes, and I always say it in person when I speak, that while I do love FinCEN and I love some of the things that they're changing and doing differently and better, they are understaffed, and that's not their fault. We just won't staff them. We won't give them the money to actually have the size staff. So I think that has an impact on the way in which they can write, the pace at which they disseminate information. So when we look at their counterparts in other parts of the world, Hong Kong Monetary Authority, the Monetary Authority of Singapore, the FCA in the UK, etc., I really tend to look at those other FIUs because, and not like because I like having FOMO, even though it does give me FOMO. I like it because it's kind of my hope that somebody in the US government is looking at these other countries that are doing this in a well thought out way. And they're looking at them and going, hey, actually, let's borrow some of that language. Huge fan of Austrac. I've said that before. I had the privilege of being part of the private sector part of the J5 and the Financial Institution Partnership Forum last year in Canada. And that was great because we got to see other law enforcement agencies at our other J5 countries, as well as their FIUs, and how they write legislation and how they guide different requirements from an AML and CFT perspective. So with that said, if you get a chance, and you don't have to read the whole thing because it is quite lengthy, I think it's worth the shock factor almost when you look at all of the documents that the HKMA published this week on guidelines for stablecoin issuers. One document stood out to me. Of course, there's a whole bunch of other documents in there that have nothing to do with the AML and CFT world. But the one document that they did publish, it's, I believe, 68 pages. It's a lot of pages, and it's just for AML and CFT guidelines for stablecoin issuers. Now, the first 10 or 13 pages was some of the feedback that they got when they were writing these guidelines, but the rest of it, well over 2/3 of it, is all about what HKMA's expectations are when it comes to AML and CFT measures for stablecoin issuers. And of course, I had FOMO because I'm like, we have nothing. We just have Vincent has 3 years to do some stuff. And, I think if anything, copy paste would be good. I mean, I think that's a great start. Hey, look at what the HKMA is doing. Let's copy paste, and then let's make edits to it based off of our own laws and things that we have in the U.S. But it's not a huge effort. We don't have to reinvent the wheel, but we need something, and we certainly can't point to decades old MSB regulations that haven't been touched in years and years and years. We can't look at that and say, oh yeah, this applies to stablecoin issuers. And we certainly can't look at, like I said last episode, at already overtaxed, understaffed, undertrained federal banking regulators and say, oh, now you get to be an expert on stablecoin. So, I'm hoping that there's some playing nice between the FIUs. But I think if you're struggling because you want to get in this market, right, either as an issuer of stablecoin or a bank partner that is interested in this market, and you're kind of flying blind a little bit because you don't know where to start, I think it is good to look at other countries. Not that those countries have any type of legal say, that's not what I'm saying, but it's a good place to start to go, all right, what are other countries that have a pretty robust FIU and their approach to AML and CFT? What are they doing in this area, and what can we leverage as a private entity, either as an issuer, as a wannabe issuer, or as a bank that wants to get in the market? Another quick heads up, in the US, the Art Market Integrity Act was put forward end of last week, I believe. It's bipartisan legislation, and I know that arts and antiquities is one of those areas in which we need some type of AML rules and oversight. So please hear me. I'm not saying don't do this. I'm just saying when these things pop up, I get a little like righteous indignation. I think that's the word, righteous indignation, where I don't understand why we're moving forward with this. Having a threshold of $50,000 in order for an arts or an antiquities dealer to be qualified to be under AML. One, I don't like. I think that's a little dicey, having a threshold that low. But two, why? Like, we just rolled back registered investment advisors, and the U.S. government in the NPRM, like I said last episode, admitted that we have trillions of dollars in investment funds without proper AML oversight. That was in the notice of proposed rulemaking before the RIA rule went into place. And so we're spending time trying to fit legislation around arts and antiquities, which is billions of dollars in activity, but we have multiple buckets of trillions of dollars without AML oversight. And that, of course, payment processors, huge, this is what I talk and write about all the time. We don't impose AML regulations on payment processors in the US. And we're talking trillions with a T, that flow through the US on an annual basis without AML eyeballs. And then you add to that the regulated investment advisors rollback. That's another trillion with a T. And so while the Art Market Integrity Act, I think it's good for a couple reasons. One of them, it's nice to see people working together. I feel like it's a pretty polarized environment. I was happy to see people from different sides of the aisle work together to close some of the gaps. But I mean, I guess I just don't understand why we are trying to fix that loophole when we have, trillions and trillions and trillions of dollars without any type of AML oversight in the US. And I just wish that we would work on those first and then, at some point get to the arts and antiquities environment. So with that, I'm going to talk a little bit about high risk customer management. And I think it's important because it's directly related. When any government, especially the US government, doesn't properly regulate and then supervise and then enforce, so all three of those, not just regulation, not just supervision, but enforce AML and CFT regulations on certain industries, there's only one main industry that bears the brunt of that, and that is the financial services industry, basically banks and credit unions. And even if we were to take credit unions out of that because they don't face the same pressure, like I've said before, that banks face from a safety and soundness perspective, that's an unfair burden. I write and talk about this all the time. The transference of risk that happens when the US government particularly does not regulate industries that other countries are regulating and have been regulating for years and years and years. We don't regulate them. So it's not that risk for money laundering and threat finance, that risk doesn't just go up into thin air. It doesn't evaporate. It just gets shifted from that unregulated industry to their bank partner, because all of those unregulated industries have to have a bank partner to have a business. It's not just fintechs, which I've said before. If fintechs don't have a bank partner, they don't have a business. Well, that's not just relegated to the fintech space. That's also a regulated investment advisor. That's also a pawn shop. That's also an arts and antiquities dealer. That's an oil company. All of these businesses all have risk that they transfer to their bank partner. But when we have non-bank financial institution buckets like RIAs and pawn shops and jewelry stores and money service businesses and fintechs and things like that are in that non-bank financial institution bucket, when we don't regulate them at all, some of them, or we regulate some, but we don't really supervise them, and then there's no enforcement, or we regulate some and there is a little supervision, but then there's no enforcement. All of those parts of the risk puzzle get transferred to their bank partner. And that's unfair and it's unmanageable. But that's the world we live in. So what do we do about it? And that's where I think the way in which we view high-risk customers and what I think most institutions have as their high-risk customer program, their HRC, that's what I call it, high-risk customer program. They have a certain set of criteria that they use, typically in an automated, AML vendor monitoring system that they have. They have criteria set up. They get this list of what the system says is a higher risk customer, and they get it on a monthly basis, some of them, which is ridiculous, or they get it on a quarterly basis. That's much better. And then their team takes those and then they perform what we do as of a high risk customer review. And we go in and we talk, in a narrative form about why we believe this customer is a high risk customer, not a high risk customer, and what should happen to their rating, et cetera. And I have trained on this. I think my first training I did was 15 years ago on an effective high-risk customer program. And when I look back at that old presentation, I get a little bit embarrassed. I'm like, oh, somebody listened to me on that one. But as I've refined it over the years, and if you've ever been to a Wisconsin Bankers Association, a Georgia Bankers Association, a Florida Bankers Association, any of my ACAMS panels that I sat on for well over a decade, any of my webinars I've been on, I have talked till I'm blue in the face, essentially, about what a proper high-risk customer program looks like. And so I wanted to talk a little bit and give listeners some operational takeaways, something that you can do in your office this week or today, depending on how much time you have. I know time is of the essence. So if you can carve out about an hour, I think that's the max of what it takes, especially if you have any type of chops when it comes to Excel, which you don't even have to, write any macros or anything, right? I'm not talking about that. I'm talking about basic stuff that you can do to uh, help get a better feel about the effectiveness of your high-risk customer program. So I have three main questions, and these are questions that I use when I'm in the middle of a remediation, when I'm doing a validation, typically, in any type of audit, any type of advisory engagement. These questions really are highly applicable in all of them. And while I'm giving away stuff for free, I'm doing it because I love banks and I want banks to win and I want them to not fail. I especially have a heart for community banks and credit unions, and I want us to make safer communities, and we only do that by having effective AML programs. So we need to move past the checkbox exercises. I know consultants will probably listen to this and take some of my questions too. Good. Please take them. Don't charge your clients for them. Take these questions and help them and let these help you ask better questions to provide better service, especially if you're a consultant. So first question: have any of your high-risk customer reviews produced any SARs? And this is a great question. I ask this all the time, whether it's an in-person group training at bankers associations, whether I am doing a custom training for a larger bank or a larger credit union. That's one of the first questions I asked. I ask is, how many high-risk customer reviews, if any, have produced any SARs? I will say 95% of the time, not all the time, 95% of the time, the answer is none. And to me, that is the 30,000-foot low-hanging fruit that your high-risk customer program is missing something. Now, am I saying this in a threatening way that you're going to have an order? No. No. What I'm saying is, if the reason why you're in this industry is not just to avoid orders, right? Avoid consent orders, but to actually find the dirty money that is in your institution, the illicit actors that are in your institution, and report them in a highly effective, timely manner to law enforcement. If that is the goal, which I think 99% of the people in this industry, that is what their heart's desire is, right? It is a super stressful, and most of us don't get paid what we should be getting paid. And so most people are doing this for that purpose. They aren't doing it for glory. They aren't doing it, to just try to stay out of a consent order. They're doing it for an underlying purpose. So if that's your purpose, please hear me. I'm not being critical. I'm trying to offer you ways in which you can see things a little bit differently. A lot of times, especially when I was an AML officer, a lot of times we get so close to it and we're so entrenched in doing the things that we know that we can get done because the key performance indicator that's reported to the board is stupid and shouldn't apply to your area anyways. But it really drives any type of creative thinking or white space thinking out of your day-to-day environment. And that's where that first question, how many high-risk customer reviews, if any, produce a SAR, that's where that first question, it is a great starting point. Because if the answer is none, then that gives you an idea that, this area may be missing something. Maybe my analysts they aren't thinking like a criminal enough because they're so overwhelmed, right? Is this a resource issue, which I talk about all the time? They don't have enough time to go out and do a full, properly done open source intelligence deep dive on this customer. They only have time to regurgitate essentially what all the transactional patterns that happened in that quarter or that 6 month, whatever your time frame is for your high-risk customer review. So that's a good place to start. If your answer to that question is yes, we do have SARs coming out of our high-risk customer review, I would like to know what kind of SARs. So my second question typically is, great, I love to hear that your high-risk customer reviews are producing SARs. Are these money laundering bucket SARs or are they fraud bucket SARs? I will say 99% of the time they're fraud SARs. And I'm not saying the fraud SARs are less valuable, and I'm not saying the fraud isn't tied to money laundering, but money laundering SARs, that's a totally different bucket for me and a totally different way of thinking and a totally different high-risk customer review than a fraud-based SAR. So answer that question just in your office. You don't have to email me. I mean, you can if you want. But the second question I think is also important. Do you have multiple inputs to your high risk customer program? Meaning, do you rely on what your AML system is telling you what is a higher risk customer? And that's your only high risk customers, right? Where you export your list every quarter or every month and you manage your list. Or is it a hub and spoke model? I think that's a great question. The third question, has your validation that you've had, independent validation, did it actually test the effectiveness of your high risk customer program and its criteria? And I don't mean, did the company that sold you the AML monitoring system tell you what other banks and credit unions are doing who also use their system, and then that's what you went with? I'm not talking about that, because I will say that happens probably 3 out of 4 institutions that I'm in when I do a validation. I'm like, oh, well, who told you that you should be weighting the criteria this way? And who told you that this criteria is even applicable to you and your customer makeup? And what I hear is, oh, well, X vendor told me that this is what other banks and credit unions my size are doing. And I'm like, oh, geez. Okay. So those are the 3 questions. If you answered no to any of those, possibly all of them, all is not lost, right? The world's, not going to start crumbling. Your examiner's not going to show up and start doing, some looking around under rocks and everything like that. But these are great questions for you to track, especially if you're an AML officer or you're a senior manager or you're over that area. These are great questions for you to track because they're great, what I call temperature checks. Especially that question, how many high-risk customer reviews have produced SARs? If you don't see that number, I mean, if it's 0 and it doesn't change, that's not a good thing. If it's 2 and you have a larger institution and you're writing hundreds and hundreds of high-risk customer reviews every year and you're getting 2 to 3 SARs out of it, and that doesn't increase, and that's something to measure as well. And while these aren't necessarily key risk indicators for something that should go to the board, I think it's something that is a key risk indicator, and for me, a key performance indicator for your own team. This is something that you can measure. How many high-risk customer reviews do we perform? 965 in year 2024. Great. How many SARs do we get out of that? 3. Okay, well, we've definitely got some work to do. Either we're performing reviews on high-risk customers that are not truly high-risk customers, and we're just like going through the motions and we're getting everything done and we're making sure that we have, all the things and we follow the form and, we've got the template. Oh, goodness, if you're using a template, please stop. The template takes the human out of it. And then you just become a robot. And it's like, well, then tell me what this person did. And then tell me what their checking account did. And then tell me what their CD did. And then tell me the volume, right? If you're using a template, please stop. That is not the best way to do it. So if you said no to any of those, world is not going to end. But there's some things you can do. High-risk customer reviews, they must be actionable. It cannot be a regurgitation of what happened. I have sample forms. All the names and dates and locations have been changed in my spare time because I never want to be a talking head. I say this all the time when I speak in person. I never want to be that consultant, that advisor that is so far removed that I'm just the talking head. And I promised myself, because I was an AML officer and I remember getting consultants that hadn't actually done the job in years, and some have never done the job. And I promised myself I would never be like that. And so I intentionally take on the annoying day-to-day stuff. I write high-risk customer reviews for clients. I do alert dispositions and investigations. I write SARs. I write no SAR filed. I have never been so far, I have never been far from that throughout my career, even as a consultant and an advisor. Yes, I can do high level strategic stuff, whatever, but the stuff that keeps me sharp is the day-to-day work. So when I am talking about things that you should do differently, I'm not talking like I'm not actually doing it. I am actually doing this. So if you need any sample forms of high-risk customer types, I've got several by types, right? I've got convenience stores, which we all know every community bank in the US has at least a dozen of them. Some money service businesses, some crypto, some clients that are engaged in crypto, PEP samples. I have a whole bunch of sample forms of what a high-risk customer review should look like, the type of information, the type of critical thinking and analysis that's in these documents. If you need them, please email me at FinCrime Unfiltered at illicitedge.com, and that's ILLICIT edge.com. Or you can find me on LinkedIn. I follow Dirty Money. I'd be happy to send you these forms. The point of these forms is not to, say, oh, you have to have it look exactly like mine. No, the point is your team needs to look at what a properly performed one with critical analysis, not a regurgitation of activity, looks like versus a regurgitation of activity. And, many moons ago, actually prior to this administration, we had a lot of consent orders and they all had a high-risk customer or a CDD element to them. Almost every single one had a failure in that pillar. So while the consent order isn't the threat that's looming, the threat that's looming is, do you know your customers enough, and are you finding the dirty money that you need to find? Because whatever gets missed now will come to light later in the next administration when they're back focused on safety and soundness. So for the second question that I asked, the multiple inputs, I have an infographic. We'll put it up. This is what I coach my bank and credit union clients on. It should be a hub and spoke model. The AML system should be one part of what your high-risk customer list looks like. But if your high-risk customer list is just an export of what your AML system says, and you don't feel the freedom to go in and say, this is not a high-risk customer. No, system, you got it wrong. And this is the reason why. If you don't feel that freedom, then you're way, way, way too reliant on that system. But there should be other avenues of input into your high-risk customer program as a whole and your high-risk customer list. Yes, the majority is going to come from your automated AML system, but your second one should come from your transaction monitoring efforts, right? And if you have a big enough team, you have somebody who's doing the transaction monitoring, right? They're reviewing the transaction alerts and they're doing the dispositions and they're doing the investigations on those alerts. That team should be coached. Hey, if you find a customer where something's not right, but you are in your transaction monitoring alert disposition phase, please refer it over to the high-risk customer team, and then we will do a deep dive investigation. That's one avenue. Another avenue, internal referrals outside of the AML team, right? This should come from your lending area. This should come, from the front line. This should come from just conversations. Somebody goes, hey, I don't know if you saw, but this person and that person, they were doing this and doing that, and that type of referral should go, and that should be one of the spokes into the hub. Another one should be negative news. If your financial institution is not willing to pay for great matching services, please reach out. I have two that I really trust. If you don't want to do that, you can do Google alerts, right? That's pretty easy. Is it going to give you some noise? Yes, of course, because it's a Google alert. But if you're a small community bank and you know that your management team isn't going to approve another third-party vendor in this area, you can use Google alerts. You can set it up. Hey, in this zip code, in this state, I want these keywords run. I want an email every time that the term money laundering in quotes appears, or drug trafficking in quotes, or prostitution, and those types of words. You can build out your own Google alerts. For the third one, about the validation, I have a pretty high standard when it comes to validations, mainly because many, many moons ago, I built an AML system along with a brilliant DBA at an institution about 20 years ago, actually. And it was a great system, and everything we used back then, I'm now starting to see in some other systems, which is nice. But the reason why validations are important is because they're supposed to be in the nitty gritty. They're supposed to be in the data. They're supposed to be looking at all of the cracks and little places to hide to make sure that your AML system that you rely on for both detection of higher risk customers as well as transaction monitoring, that both of those are effective, not statistically sound, right? So the whole above the line, below the line testing just really irks me because a monkey could do a statistical deviation analysis, but that doesn't tell you whether or not the parameters that you have uh, to monitor for suspicious activity and transactions is appropriate for the threats that are specific to your institution. The same thing on the high risk customer side. Just because we look at statistically how many customers are rated as high risk and what that looks like as a baseline, right, with your denominator of the number of customers that you have. That's like statistical gymnastics. No one cares. It doesn't move the program forward. What you really need in a validation and what you should have as your standard, and other firms can do this, they just won't do it because you're willing to pay for something less. The thing that you should be asking for is, look at my risk criteria. Is it appropriate for what you can tell about my institution? Is the data valid? Is it there? First of all, 2 weeks ago, I was doing a validation for a smaller community bank, under $1 billion, and the majority of their industry codes were not present, but no one had ever brought this up to them in prior validations and audits. No one. Yet a large part of their risk weighting for their high risk customer determination for that criteria had to do, and it was assigning risk points to the NAICS code, but the NAICS codes weren't even filled and it wasn't even a priority for them. That's like a baseline thing. To me, industry codes are as important as CIP. I think I said that on the last one too. It's as important, if not more important, for businesses to have the industry of that business. So you need to make sure that the data is there, but you also need to look, and your mindset should be, is this criteria applicable for the threats within my institution, right? If you're a $1 billion community bank with a couple branches, but in the same area, the majority of your people, of your customers are retail consumers, you have a few businesses, you need to make sure that that risk criteria is tailored to the risks within consumers, right? Don't apply the same risk criteria for consumers that you have for businesses, and vice versa. 2 months ago, I was doing a validation, and it was mainly a commercial focused business without being a commercial bank. But when you look at the breakdown of their customers, I'd say about 60, 70% of their customer types were non-individuals or businesses. And then the other were individuals, and their high risk customer criteria. There were a few issues, but one of them was they did not use different criteria for each bucket. They had businesses and individuals all lumped into the same scoring methodology. And that meant all the risk criteria pieces, and then all the weighting, and then the eventual calculation of the points, and then the cutoff for what points aggregate to low, medium, and high. There was no point aggregation differentiation for businesses than for consumers or individual persons, which led to the majority of the high risk customer list being businesses. And I see this so frequently. The majority of the customers on the high risk customer list were businesses, not consumers, because the scoring, all of the weighting, all the criteria was all focused on businesses, but not consumers. And then the scoring for the cutoff was all the same. So, if you scored more than 25 points, then you were considered high risk, but 2 of the 5 pieces of risk criteria were not applicable to consumers. But then they're all held to the same standard. So if you're looking at your risk criteria and you're going, oh yeah, the same weight that we have for the, NAICS code industry, that's at 20%. And then our transactional activity is 20%, and then our zip code is 20%, and then our product type is 20%, and then our whatever else is, the country risk or whatever, right? It can vary, is 20%. If that's what you're seeing, I would encourage you to take a different view. Now, I can't tell you exactly what it should be because it should be tailored to the threats in your institution. But when you look across and you see the weighting is the same for all of them, something's wrong. I am telling you, the risk that's passed on to your institution because of the industry associated with a business is not the same type of risk that's passed on because of a zip code. Especially if your bank is in a HIDTA or a HIFCA, or a HIDTA. I never know how to pronounce it. A HIDTA or a HIFCA. If it's in a high intensity financial crime or drug trafficking area, your bank is, so all of your customers are, that should not be 20% weighting the same risk that's passed on to you as the industry of that business. So, there's just a few things there to refine and to look at. Certainly not a criticism. I get super passionate about it. I just started noticing the amount of hand movement I had when I was talking. But, it's something, at least with these three questions, will it fix everything? No. But I think these are three great starter questions. And like the last episode I offered, if you need the NAICS code industry list with the FinCEN category or risk assignment overlay, please reach out. I'd be happy to email it to you. I've sent out several copies. And I know, dang it, I went overtime again. But there are a lot of things I think that banks and credit unions can do differently to make sure that their high-risk customer program, high-risk member program, is effective and accurate and adds to their program, right? It's not just a time suck where people are having to, write these reviews that just kind of go into the ether and nobody cares about them. That doesn't have to be your, lot in life, right? You too can have a different high-risk customer program. So any more tips or questions, please feel free to reach out. FinCrime Unfiltered at illicitedge.com. Thank you for listening, and please don't forget to like and subscribe, and we will see you next week.